Today on InvestTalk, we discuss the inflation adjustments to tax brackets in 2025. Then we look at some big earnings moves in markets today. We answer questions about ConocoPhillips, Synaptics, ASO, and more. And at the end, I look at why hiding out in cash is a bad idea.
This is InvestTalk, independent thinking, shared success.
Now, our main focus point today is about the 2025 tax brackets that will soon be upon us. And Americans are likely to see a potential adjustment down in their overall tax burden. And while the IRS hasn't announced the new tax brackets quite yet, experts are already forecasting next year's adjustment, mainly by using the same inflation data the IRS uses in these annual resets. And it's basically the chain CPI, which is a bit different than your normal CPI index. It reflects the trends in monthly spending and the balance of monthly spending. You know, if more people are spending more on X versus Y, it will adjust accordingly. And currently, that is at about 2.8%. And that's likely to be what the adjustment will be for the tax rates in 2025. That will mark the smallest inflation adjustment in the last 3 years. It was 5.4% in 2024 and 7.1% in 2023. And this will help avoid bracket creep, where it's like, okay, I'm earning more money, but now I'm just pushed into a higher tax bracket, so my raise isn't as much, right? And so these tax brackets are now linked to this chain CPI. Now the brackets will remain the same: 10%, 12%, 22, 24, 32, 35, and 37 on the federal level. It's just the dollar amounts, those limits will go up. For example, if you earn $48,000 in 2025, your marginal tax rate will be 12% versus in 2024, if you earn $48,000, that last roughly $1,000 would have been taxed at 22%. And so for that person earns $48,000, they'll actually get a slight raise when the new year rolls around, because now they'll be all of their money will be taxed at that 12%. And that's something a lot of people don't understand, that they think that if you say earn $100,000, and you're in the 22% tax bracket because you earn $100,000. This is somebody married filing jointly, okay? This year, the limit's $94,300. Next year, it's going to be $96,951. But let's just go based on this year. So if you're in the 22% tax bracket, you earn $100,000, married filing jointly. A lot of people think all of their income, all that $100,000 is taxed at 22%. It's not, okay? The first 10%, or the first $23,200 this year is taxed at 10%, okay? And then the amount between $23,201 to $94,300, that is taxed at 12%. And then from $94,301 to $201,050, that is taxed at 22%. And then there's a few more tax brackets above that. But it's each bucket of income is taxed at that separate rate, okay? And that's something a lot of people do not get. They think that, it's all, once again, taxed at whatever tax bracket that they are in. Next, standard deduction. That's going to go up as well by about 2.8%. For next year, it's projected to be about $30,000 for married couples filing jointly, up from $29,200 this year. For single taxpayers, expected to go from $14,600 to $15,000 next year. And for head of household filers, standard deduction is expected to go from $21,900 to $22,500. Okay. And those married filing separately, it will increase from $14,600 to $15,000. So those are the major changes. And understand that when you are calculating your taxes for next year, that it's not just all taxed at one rate. Okay.
Stay informed with exclusive insights by subscribing to the KPP Premium newsletter today.
Now let's take a quick look at the market today. It was certainly a red day overall. If I take a look at The Morningstar style box, only large cap value was actually up a little bit. You had large cap growth down about nearly 0.5% there. Small cap growth also down nearly 1%. So certainly value outperformed on the day. It was a mixed bag when it came to sectors. Most of them were down, but nothing too dramatic, to be frank. Of the big tech names, you had Apple and Nvidia and Amazon. Those were flat. Microsoft was up about 2%, best performer of the mega cap names. Let's see, Tesla was flat. Google was up about 0.5% there. Meta up a little over 1%. And not a whole lot of huge losers. You had Lockheed Martin, though, down about 6%. GE was down 9%. So that was interesting. So some big movers. Philip Morris was up about 10% on earnings. And we're in the midst of earnings season right now, and so you're going to get some of these big movers here. But overall, it was a modest down day. You had the S&P only down a little less than 3 points, 0.05% there. Nasdaq was up just a bit, but still, value side outperformed on the day. And yeah, not a whole lot of news, to be honest with you. Let me look at any big winners. Yeah, GPC, Genuine Parts, that was down 21% on the day. And that was an interesting one because I've been saying for a while that was the type of industry that did very, very well during the pandemic. And then suddenly the demand for aftermarket parts reverted to the mean. And that happens a lot in markets, is reversion to the mean. Businesses pretty much don't change their stripes very often unless you're in the tech space. And that means that oftentimes companies are either over under earning based on kind of short-term factors, and long-term trends tend to reemerge. And that's what you're seeing in the aftermarket car part market right now. And so that was a big mover on the day was GPC. Let's see, any other big movers here? DJT was up about 10% today. So continuing trend of the market pricing in a higher likelihood of a Trump presidency. Still, in my mind, roughly 50-50. I'll give maybe Trump a slight odds there, but anything could happen a couple of weeks from now. So that was the market today. You had gold. What did gold do? Hey, it was up once again. And I think that's the story here that nobody's paying enough attention to. Is there's a lot of messages you can take from this rally in gold and silver and the relentless rise that you continue to see. And so everyone should be standing up, taking notice. Unfortunately, not many people are, especially those average retail investors here in the United States, still chasing tech stocks, still chasing Bitcoin, and not paying any attention to what's happening in gold and silver, and they are mooning currently.
Hey, Justin and Luke, this is Neil from Chicago. I had a quick question about COP, ConocoPhillips. I own a little bit of it in my portfolio, and I was wondering what your thoughts are around COP. It's been fairly volatile the last couple of months. I'll listen in on the show. Thanks for your feedback.
All right, looking at ConocoPhillips, and the whole oil space has been down as of late, and ConocoPhillips is not immune to that. It peaked around $135 per share. Now we're down about $105. Now we do own this for clients. We owned it for a while though, so not recent, not a recent purchase. So we're still doing well from a few years back, and it's a business that is very profitable. Obviously, profitability is coming down. Earnings are supposed to drop 12% this year, but go back up 6% next year. And they have a pretty clean balance sheet. Only about $13 billion in net debt in its balance sheet. Return on equity, even with profits ebbing a bit, still 21%, 22%. You round up there. And so we still like ConocoPhillips. It's one of our favorites in this space. One of the big reasons is because they're focused on returning capital to shareholders through dividends as well as share buybacks. And they've been doing that as of late. If you look at since basically March of 2021, when they had 1.35 billion shares outstanding, they now only have 1.16 billion shares outstanding. So they've been consistently using that cash flow. Free cash flow right now is about $9 billion trailing 12 months. And that's actually inflecting a bit higher on a $121 million market cap. It's a pretty nice, sizable 8-9% free cash flow yield. So I we really like it. And yes, it's down with the whole industry, but these are the type of names that you want to pick up when the sentiment is down, even though the quality of their business is still very good and they have a good balance sheet. And once again, returning capital to shareholders, which is extremely important in an industry like energy, where there can be a lot of misallocation of capital. So they're very prudent with their capital allocations, and we like that. So we gave ConocoPhillips a thumbs up, and I would continue to hold if you like the oil space. Now, I hope you've been telling your friends that our InvestTalk audio podcast is available in video form. You can see my face as well as my charts that I am going over each and every day when I get a caller question. And you can also comment in those videos as well. So I encourage you to head over there, and we will answer questions from the comment section. And we'll do that right now. Matthew Bird said, I'd love to hear what you're thinking of Synaptics, SYNA. It appears that revenue has cyclically bottomed, not particularly expensive at trough multiples in a particular area of growth. It performed terribly for a few years, but I'm wondering what you might think of it going forward. So SYNA is the symbol. And yeah, the trend is certainly down. If I zoom out to a weekly chart here, it peaked right around the growth stock peak back in late 2021 at nearly $300 per share. Now we're down to 62. Sorry, the low was 52-week low was 67 and change. Now we're at 72.60 at the close today. Frankly, it's just showing bearish consolidation currently, at least on the weekly chart. If I zoom into a daily, it does look a bit better, but not to a level that's getting me super excited to jump on, to be frank. Now, from a fundamental perspective, yeah, earnings look like they're pretty good. So it's earned $3.44 this year. That's up 53% from $2.25 last year, which, yeah, would be trough earnings. They earned $13.54 in 2022. It looks like a lot of those future purchases of their gaming controllers and keyboards and mice and all the things that go into, and that's mainly what they make, right? They make a lot of those gaming products that people use on their PC, et cetera. And so it's historically a very good business, but a lot of those sales were pulled forward during COVID. Now, return on equity right now is about 10%. Long-term average or long-term median is about 14%. So, I think profitability could go up a little bit. They have a good balance sheet. That's one thing I would say I like about it. And if you look at free cash flow, though, it is negative. And that's what worries me, is how much longer will that stay negative? So, I like the business. I like that they don't have any debt, but I would want to see the free cash flow start to inflect positive before I would jump on. So to me, it's still a wait and see on the sidelines for Synaptics, partly because of the chart and partly because of that negative cash flow situation. Okay. Thanks for the call. Let's keep things moving forward and play another caller question from 888-99 chart.
Good morning. This is Randy, the Iowa trucker. Just have a quick question about DRIP, Dividend Reinvestment Program. I know that situations change from time to time, so I just like to update. What is your current advice or recommendation for anybody interested in reinvesting? Or should they let it go to the sweep account and focus it on a particular part of their portfolio at the time? I hope that made sense. You have a great program. Thank you very much.
Thank you. And what he's talking about is our dividend reinvestment programs. Now, a lot of companies had this for a long time, and I think companies still do have it, where you can buy shares directly and all the dividends would go directly into more shares as opposed to taking the cash. And back in the day, it used to be great because you could avoid the transaction costs of buying more shares. And it would just, again, be kind of held with the company. Now, a lot of brokers have dividend reinvestment options where you can toggle them on, and then all those dividends will be reinvested in those shares as well. But the commissions don't really matter anymore because there aren't any commissions for equity trades. So you're not really getting around that part. And I think it's fine to have them as long as you keep an eye on the weighting in the portfolio. Ideally, you want to have a specific weighting for names, and over time, if it pays a dividend, you're reinvesting it. It could rise above the weighting that you want for that particular position. Or maybe the stock's underperforming and you are reinvesting in a company that's sinking, right? So I rather take the cash. We take the cash for our clients and then judiciously reinvest that into that name, maybe into a different name. Once again, it's really about the target allocation for your portfolio. So I don't love them. I don't hate them. I think they're fine. It's just more about what your overall target goals are for your portfolio and whether a drip will help with that or take away from that particular allocation target. So I have no issue with that. Now let's pivot over to a voice bank call from our 24/7 voice bank line at 888-99-CHART.
Hey, Luke and Justin, Bill from Philadelphia here. Calling about Rivian, ticker symbol RIVN. I know you guys discussed this over the show in the past, and it just touched around the $10 mark in July. Went to around 17, 18 after the Volkswagen partnership news. And I wanted to kind of get your thoughts if this would be a good stock to take a flyer on. I know that the growth and the profitability isn't there yet, but possibly something to hold for 3 to 5 years and see where it goes. Just wanted to get your thoughts if this would be a good point to get in that. Thanks for what you guys do.
Thank you. And Rivian did partner with Volkswagen, but it hasn't changed the trajectory of their business. Earnings are still expected to be negative. Now, less negative next year. So it's to be $4, or supposed to lose $4.13 this year from $4.81 last year. It's supposed to only lose $2.92. But it's a $10 stock. You're losing nearly $3, $4 per share. It's crazy. This is a terrible business. Free cash flow is negative $5 billion, and this has nothing to do with the cars. The cars look great, and I wouldn't mind maybe driving a Rivian if I wanted to go all electric, but you just can't justify it from the numbers here. And what are they doing to finance that $5 billion? They're just issuing more and more shares. And so really the only play here is that if the partnership goes well with Volkswagen, that they'll just buy it up. But they could easily buy it up from, down when it's $2 a share and buy it for $5 or something, which is well below where it is trading today. So this is not an investment. And whenever you're thinking of taking a flyer, it's probably not a good idea, and you're not investing, you're just gambling. So I would absolutely 100%, 1000% pass on Rivian. For more insights and resources, visit us at InvestTalk.com. Let's go talk to Joshua on a live call from Dallas asking about ASO.
I own some, and I've done a couple of valuations on it, and the price just doesn't make a whole lot of sense to me where it is, so I'm wondering if I'm missing something.
You're basically saying it should be worth a lot more.
I keep getting a fair value somewhere closer to 85 a share.
Yeah, I honestly don't have any issue with that. I mean, free cash flow is about $400 million on an enterprise value of $4 billion. That's about a 10% free cash flow yield. Now, I think the biggest issue, though, is lack of growth here. They did very well during the pandemic. Earnings hit high of $770 in 2023, but were $696 last year. It's supposed to be $627 this year, but back up next year. And frankly, can they keep this level of profitability? I think is the big question here. When IPO late 2020, so kind of in the midst of the pandemic, and they've been able to keep this profitability at least for a few years now, so that's good. And a lot of people are moving to the south, cheaper places to live, and so population growth is good there. They have no debt in their balance sheet, pretty much. They're buying back shares. So they're doing smart things with that good free cash flow. They pay a dividend, but it's not very big, about 0.8%, but certainly has room for it to go up from there. The technicals certainly are mixed, but overall, it continues to be an uptrend, making a series of higher highs and higher lows. Frankly, I would hold it. I think its profitability is still good. I have no issue with it. I don't see any really terrible negative trends. It's just a slow grower, and that's why it's not getting a high multiple.
All right. Thank you so much.
Thanks for the call. Now, let's touch a bit on the debt loads coming late next year and into 2026. There's a wall of debt, and oftentimes bull markets climb a wall of worry, and then they hit a wall when there is that maturity situation that requires a lot of what we call balance sheet capacity in order to roll over that debt. And then there's just not enough. And so money has to come out of equities and other places in order to make room for that refinancing. Okay. And like I said, late 2025, there will be a sizable maturity wall of different types of debts, a lot of corporate debt. And history shows that financial stability requires a balanced ratio between the stock of debt and the amount of liquidity available to refinance that debt. If there's too much debt relative to the liquidity, then you get a deflationary force like '08. You get a financial crisis because there's a lot of defaults. And if you do the opposite, you get too much liquidity, then you get that money just flowing into asset prices and you create asset bubbles. So policymakers have to figure out a middle ground going forward. But as the amount of debt in total rises, there needs to be the amount of balance sheet capacity required to handle those refinancing. And frankly, the level of interest rates matters a lot less than the actual balance sheet capacity. Because it doesn't matter what the interest rate is, if there's no balance sheet capacity, then those debts cannot be refinanced. Those debts cannot be rolled over and they default. So it demands an ever larger amount of liquidity to really grease the wheels of the global financial system. Now, lately, global liquidity has been rising pretty dramatically, fueled by bank lending, higher values of collateral that's supporting the loans. Think of asset prices. Think of your home, right? Those prices are going up. Equities are going up. And you have central banks also easing policy as well, and that's helping with liquidity. Now, $16.1 trillion of global liquidity has come into the system over the past 12 months, and nearly $6 trillion just since the end of June. And total liquidity is $175 trillion, about 1.5 times global GDP. And it's rising at about 15% annually. So I say this all the time. Near term, liquidity matters far more than anything else, far more than the fundamentals of the companies that are in the marketplace. And so understanding liquidity dynamics, whether they're ebbing or they're flowing, is vital to where asset prices are going in the short term. So if you aren't monitoring that, then you're really not understanding where asset prices are going to go. You're just flying blind. Now, since 1980, the ratio between advanced world debt and global liquidity has averaged about 2.5 times. In the crisis of '08, it was 2.9 times. In the Euro crisis, it was also elevated. And by 2027, it's likely to exceed 2.7 times again. So what that means is that more and more liquidity is going to be needed for as debt values go up over time. So policymakers are going to have to manage this liquidity rather than move interest rates. Interest rates make the headlines, but liquidity is really what drives markets. And so to handle the higher level of government debt, global liquidity will need to expand at about 8 to 10% per year, which means the aggregate size of total debt in the system will double every 8 years. Think about that. And so that's kind of the point here, right? Liquidity is going up at about 15% annually when only about 8 to 10% is needed. That's kind of that balancing act, right? And they're providing too much liquidity, and that is why you are getting higher asset prices. And so I wanted to touch on that because it's so vital. It can be complicated. It's not as complicated as you think, but you have to be paying attention to the right metrics. Is the government spending? Are banks lending? Those are really the main drivers of liquidity. And then you got on top of that central bank activity. Are they issuing more short-dated treasuries, which is basically cash that can be used as collateral in the system? Whereas longer-dated securities, 10-year bonds, there's risk there, right? There's duration risk there, and it's not cash-like. So it can't be used as collateral quite as well. And so all of this is extremely important to follow and understand if you really want to know where markets are headed in the next 2, 3, 4, 5 months. Now here comes another live call. James from New York is asking about rollover options, and he listens via our podcast.
Yeah, I'd
James?
like to know, my employer offers a 401k plan, in this case with Principal Financial Group.
Mm-hmm.
If I were to call the company, Principal Financial Group, and request an in-service rollover into another plan, say like a traditional IRA, that way I could have more investment choices, is that something the company principal would accommodate? Or if my employer doesn't offer it, then I don't get to do that?
Principal should offer it, but how old are you, James?
I'm 37.
So you have to be 59 and a half to do an in-service rollover.
Okay, so there's nothing I can do in the meantime if I'm able, if I want.
Yeah.
Okay.
Now, what you can do is, remember, the managers of your company have a fiduciary duty to you and your fellow employees to put together a plan that's in your best interest. Now, what you could do is push them to offer a self-directed brokerage account that's linked to your 401k that allow you to opt into a brokerage, basically a brokerage account, over at whatever principal uses. It might be Fidelity, it might be Schwab, it might be E-Trade, but typically they offer something, but your employer has to opt into that for you guys, and then you guys would, all the employees would have to opt into the self-directed brokerage account from there. So that's one way to do it. Obviously, no matter what, whenever you change jobs at some point in the future, if you do, rolling that into an IRA would immediately be available, and I would do that.
All right, okay. Thank you.
Yeah, no problem. Thanks for the call. There's another question from our InvestTalk YouTube channel. Jay Soso says, can I get your thoughts on PLNH? PLNH, especially with elections coming up. Okay, PLNH. Let me pull this up here. This is Planet 13 Holdings, manufactures and distributes medical and recreational cannabis in Nevada. Now, the technicals are improving, and it moved up in August from about 30 cents all the way to about 70 cents, and it's been consolidating right around 60 cents where it closed today since then. And so that's a bullish consolidation pattern, and earnings are supposed to go positive this year. So that's a good thing. But it's a tiny name, 133 million. And the big question is, no matter who wins, are they going to get to a point where they're going to legalize cannabis nationwide or decriminalize it? I don't see a strong push. Excuse me. Either way. So as a flyer, I guess, when you're gambling here, the technicals, once again, are improving a bit. But they just hemorrhage cash, and I don't know how much the legalization or decriminalization of it will help them. Let me see what they do. Are they company cultivate production dispensary operations in Las Vegas? Okay, so looks fairly vertically integrated. I don't necessarily think that this is a great bet, but I could see it working out. Let's just say that. Very high risk. Once again, they don't make money. I don't think legalization will certainly help them long term. Now, could it be for a trade, right? Whoever gets elected and they start to go down that road of decriminalization, near term, it would help it. You have to say that. But I don't see this as a long term hold or anything like that. Thanks for the question. Now I've got time to drop in another 24/7 voice bank call. You know the number, it's 888-99-CHART.
And I had a question about dividend stocks. In the past, I've heard you guys say that when they pay a dividend, say 7%, for instance, the price of the stock the next day will drop 7%. So technically, does that mean that in order for you to actually be making money, does the stock over the next year need to go up 7% minimum to even be able to have covered the price of that dividend? It just made me wonder, with how stagnant a lot of the markets have been, is that normal to expect a gain like that and then still get paid your dividend? Just wondering if some of these stocks are just eating themselves while they pay you out your own money and not really go up. Thank you. Bye.
Well, you just got it. Yes. Now you're kind of using probably wrong numbers. You don't say 7%, but usually there's an amount per share that it will pay out, and usually the stock upon open will drop that amount and potentially more or less depending on where the market's moving. And yeah, in order for you to get that back, the stock would have to return to that pre-X dividend date price, and that's what I always say. That's why I think dividends are overrated. Now, do they have no value? I'm not saying that. Right? A lot of people mince my words and they think that I'm black or white. I'm not. There's a gray area here, and my issue is always that so many people are dogmatic about dividends. Has to pay a dividend. I need my dividend. Dividends are the return on your ownership in that company, and that's not true. There are the price appreciation. Companies can buy back shares, and in many parlances, that's a better way to return capital to shareholders, because then they can take the gain whenever they want, as opposed to forcing dividend investors to pay tax on that dividend each and every year, especially if it's in a taxable account. So the reason it drops is because suddenly that amount is now segregated from the shareholders and is going to be sent to the shareholders in a matter of weeks. And so that's why the stock drops, because if otherwise new buyers, they're not getting that dividend, right? They're not entitled to it. So if you bought it the next day after the X dividend, well, then you're not entitled to it. And so that's backed out of the value of the firm. That's why the stock drops there. And so your simple answer is, yeah, otherwise that's just dropping in value and offset, and you're offset by the dividend that you're getting that you're now have to pay tax on. And so dividends are fine, and they're good to keep management honest, making good allocation decisions, but that's kind of it, okay? And that's why I always say we focus on the quality of the business, quality of the balance sheet, quality of the cash flows, etc. That is what you want to focus on, not just some shiny 7% dividend, okay? Thanks for the call.
Thank you for tuning in.
If you enjoyed this content, please give us a thumbs up and subscribe for more updates. Let's talk a little bit about cash or cash-like holdings. And money markets certainly qualify as that. Now, more than $6.4 trillion have been inserted in money market accounts. It's an all-time high. But we know that those yields on those funds are coming down, and it's a downward trajectory. You saw the Fed cut 50 basis points. They're expected to cut another 50 basis points by year end. And with that being the case, a lot of people are starting to question the whole cash is king mentality and starting to think, what should they do with that money? Because they know that, 4.5 or so is good now, but we know that's going to head closer to 3 as time goes on, especially because we know the government can't sit here and pay this level on its debt for very long. And so you have to look at cash's returns compared to equities over the long term if you're going to make a sound decision with that money. And over 1 year, cash has a low probability of success compared to equities. Just look at this year, right? 5% sounds great. You came into the year, 5% return on your money. What they say, T-bill and chill. And it sounds cool, but equities have crushed. No matter what slice of the market really you're talking about, it's crushed the 5% T-bill and chill mantra. And the reality is the longer you hide out in cash, the more it is going to cost you. It's really a loser's game to try to raise excessive amounts of cash to time a correction. Even though the numbers continually say, don't do that, and people still do it, right? And investors, especially heading into election, they do that as well. They head into money markets thinking the world's going to go to hell in a handbasket if the other side wins, right? That's the idea, if this person gets in, the world is they're going to crash the economy. And so they go into cash. They hide in cash. And what we know is that inflation will eat that away. Even if cash earns 5%, inflation at 3% is only 2% positive. But we know at worst case, cash has a long history of offering negative real returns. And when you scour the population, Morningstar found that 10% of the population are comfortable thinking 10 years and beyond. And you know what that coincides with? Coincides with their wealth. They're the richest segment in the survey by a wide margin. That means 90% of the population thinks shorter term. So if you can figure out how to think longer term or find a professional to keep you on the right path, then you're more likely to be successful. So you need to build investment portfolios that fit your risk tolerance level, but also take some risk out there, right? But take risk in a smart manner. So if you're in all equities, which are likely to do better, but you're not super comfortable with a ton of risk, well, screening out higher risk businesses would be number one. And focusing on companies that have long-term competitive advantages, good cash flow, strong balance sheets, etc. Those type of businesses typically don't have large drawdowns. And so it's about slow and steady. So you don't have to take maximum amount of risk. Just take a decent amount of risk that you're comfortable with and know that cash is unlikely to really outperform. That's why you only want the money that you need in the short term or some sort of emergency fund, call it 6 to 12 months. That is all you need in cash or cash-like investments like money market. Beyond that, you need to take some risk. Now, it could be just corporate bonds, high-yield bonds. It could be dividend-paying stocks, maybe a mix of both. Maybe it's a covered call strategy. That can reduce your overall risk as well. But clearly, staying in cash is going to eat away at your purchasing power over the long term. So the key is to focus on the probabilities and put those probabilities on your side. That's what investing is about. Yeah, a lot of people think that investing is a casino, right? You're gambling, but in reality is that it couldn't be farther from the truth. That this is an endeavor that you can put the odds in your favor if you know what you're doing. And so make a commitment to investing in durable competitive advantages, attractive valuations, shareholder-friendly management, and strong balance sheets. And if you do that, you will get ahead over the long term. Well, that about does it. I'm Justin Klein. This completes another InvestTalk program. We thank you for listening, and we encourage you to tell your friends and family about our free podcast downloads, which you can find anytime at iTunes, Spotify, Google Play. And be sure to rate and review on iTunes as well. And remember, we can help you better understand your portfolio dynamics and calculate your investor risk number by heading over to investtalk.com and clicking on the portfolio review button. And this is a free and confidential service. Independent thinking, shared success. This is InvestTalk. Good night.